Hello, welcome everybody to this second part of the cost of capital under the lecture series Mineral Economics and Business. In the current lecture, we will be talking about the cost of capital, again recapitulation little bit, as we have already covered the dividend, the debt related your different cost of capitals. Here we will be talking about the equity shares in particular, and then combination of the debt and equity, as you know, the preference shares, and we will touch the ideas of the cost of capital related to the retained earnings. There will be problems and solutions for each of these topics. When any company, as you know, we'll just try to remember what we said in the previous lecture, that when a company raises funds from various sources, it must pay an extra amount in addition to the principal. So that we call actually the cost of capital. The cost of capital, therefore, refers to the return expected by those who provide funds to a business. So that is their expectation from their side, like the shareholders, lenders, or the debt holders. That means the people who purchase the debentures from us, from the company. So the extra money paid is essentially cost of using the capital. This is the right language to understand. Cost of using the capital, in short, we call is as the cost of capital. That means we are using their the capital provided by them, fund provided by them, how much actually we are paying back. So we are actually in real terms how much the expenditure for using this capital is the cost of capital. So the cost of capital has other uses, like measure is the discount and the compound to compound the cash flows. In financial calculations, we need this cost of capital. Here we will talk about the cost of equity share capital, and it is by definition the expectation of the equity shareholders, because they are the holder of these shares or equities, and how much do they expect from the company. There is one more term, that's a common term, is value, which is determined by dividing the performance by expectation. How much it is performing, a particular instrument like this equity or debt, divided by what you actually expected. That is known as the value. Now, if you know the value and performance, we can calculate expectations as a balancing figure. So the performance, how to judge the performance of it? By the company, what the company is paying to the investors, like the interest that the company pays to the shareholders, or like the dividend that we are paying. Interest we are paying to the debt holders, dividend we are paying to the shareholders, or redemption price in preference share and debenture holders, we pay when it is returned back to the company, we pay redemption price. So for debentures and preference shares, the amount of the interest is or the dividend is fixed, that we know. But for equity shares, it is uncertain. It is not certain. We don't know how much dividend we get from a company against the shares that we have. Now that's why there are many approaches for calculating the cost of equity or share capital, depending on in various factors. Like the dividend price approach is one of them. This is used when the dividend is expected to be constant, and the other one is the earning price approach, which is when the earning per share is expected to be constant. But when there is growth, that we expect that it will grow, then we have a very well known model called the Gordon's model, which is used when dividend and earnings are expected to grow again at a constant rate. Then we have the realized yield approach. This is used when it is difficult to forecast the future and relies on past data, which is a very realistic situation. The situation is, most of the cases it is not possible to understand at what exact rate it will grow, whether it will remain constant or grow at a particular rate. So, the realized yield approach is much more realistic. And there is one more very well known and very widely used, is the capital asset pricing model, when cost of equity depends on risk related to various factors. So, these two will be covered, the last two, this one and this one, will be covered in the subsequent lectures. We will cover in this lecture we will be covering the prior 1, 2, 3, number 1, 2, 3, this much will be covered in this lecture. So, let us start with the dividend price approach, which is also known as dividend valuation model. This particular model, we assume that the dividend per share remains constant forever, it does not change. So, the cost of equity here is computed by dividing the expected dividend by the market price of the share, say P naught, where the cost of equity here is KE, and D, as we know, is the expected dividend, also we can write as D1 also, and P naught is the market price of equity. So, the calculation is pretty simple. The cost of capital here is equity, say KE, will be the expected dividend is, for example, here is D, and the market price of the equity is P naught. So, it is simply calculated like that. This is the, in terms of percent, when you convert, then it becomes the cost of equity, that is all. For example, this Laxmi Minerals pays an annual dividend of say of rupees 6 per share, and the market price of the share is 200 now, and we get rupees 6 dividend, annual dividend. So, the cost of capital is simply 6 by 200, which is 0.03 or 3%. It is a simplistic calculation, but it is a starting point from where we can go from much more complicated models. Now, what is this earnings price approach? This will link the company's earnings to the market price of its shares. So, it assumes that the cost of equity is determined by the expected rate of earnings of the company. So, the investors will expect a certain return from the company, whether through dividend or retained earnings. So, here we say that KE, or the cost of capital here, earning price approach, is E divided by P, where E is the current earnings per share and P is the market price per share. So, this approach assumes that the earnings per share will remain constant forever. So, that is why there is no growth model is involved in this. So, it is simply is in place of dividend, if you are putting the earning, then it becomes the same model. Only thing is that it depends on the focus is on the earning. So, otherwise, if you just if you just remember the dividend price that we have just seen earlier, then it is same model. Only it seeks to nullify the effect of changes in the dividend policy, nothing else. Say for example, that if an investor expects from the company in which he is going to subscribe for shares should have at least 20% rate of earnings, not the dividend, then the cost of equity share capital can be construed on this basis. So, here suppose the company is expected to earn 30%, then the investor will be prepared to pay rupees 150 for each share of 100. Why? Because the earning is 30% expected and the price at least 20% rate of earning the investor is expecting. Then the earning divided by P is 30 by 20 is 1.5%. So, if 100 rupees is the cost of equity, then you will be ready to pay 1.5 times this to get a 20% rate of earning from the 100 from each share. So, that is how it is calculated for when we relate these things to the earning of the company, and it is slightly different from what we have calculated earlier. Here we are relating the earning of the company and how the investor is prepared depending on the his expectation and the company's expectation from there. Now, the growth approach, here we are expecting that the dividends will grow. So, the rate of dividend growth remains constant in this particular model. So, earnings, dividends and equity share price all grow at the same time. So, the cost of equity capital is computed as follows. K is the cost of equity equals to D1 by P naught plus G, where D1 can be computed as D naught is the current dividend and D1 is the next expected dividend, next year expected dividend. So, that you multiply 1 plus G, where G is the constant growth rate of the dividend. From there we can find out the value of D1. Now, if P naught is the current market price per share and if new equity shares are issued and flotation cost is incurred, in that case we will have to a little bit adjustment, which we will be seeing here. So, in the beginning we have this cost of capital simple model D1 by P naught plus G is the annual constant growth rate of dividend. But if there is a flotation cost per share, then we can simply deduct it from the face value of the share. That means, it becomes D1 divided by the price of the share minus the flotation cost per share. So, that part is given here, plus G is the growth rate. So, from there you can calculate the cost of capital, where here the F is the flotation cost. Now, the calculation of G dash or the growth rate is definitely an important factor in calculating the cost of equity share capital. So, generally we have two methods to determine the growth rate, as we see now, that for example, the current dividend is Dn and D naught is the current dividend and Dn is the dividend in n years. So, the Dn can be calculated based on the D naught. So, Dn is equal to D0 into 1 plus G raised to the power n, where G is the growth rate. So, now if I just calculate like this Dn by D0, then this side we have 1 plus G raised to the power n, and from there the growth rate can be calculated as Dn by D naught whole raised to the power 1 by n minus 1. From there we can calculate the growth rate. This is averaging method, that we know this end and the other end after n years. So, from there you can calculate by averaging the whole thing, and we take G as the growth rate, and it becomes G equal to Dn by D naught raised to the power 1 by n minus 1. So, unlike the average method, in Gordon's growth model, it attempts to derive a future growth rate. So, according to this particular model, increase in the level of investment will give rise to the increase in future dividends. So, in this model, the earnings retention rate, apart from a constant flow of dividend, what we are expecting that if your retention of earning, that means you are investing more from the profit that you are earning, and rate of return on the investment into account, then we can estimate the future growth rate as B into R, where B is the earning retention rate and R is the rate of return on fund that we are investing. So, this as you know that the proportion of earnings available to equity shareholders which is not distributed as dividend is the retention retention of the earnings. That means a part of the earning is retained back to the company itself for investment and growth of the company. Now, we will take an example to understand this. So, for example, this company Brilliant Metals has paid a dividend of ₹1 per share for the face value of 10 rupees each for each share last year, and its retention ratio is 0.7. That means 70% of the earning is used as a retention of earnings and reinvested for the purpose of growth of business. Now, and retention this rate of earning is 15%. Then we can calculate the cost of equity. If the market price of the share is 55, we can now calculate as this. So, the cost of equity, as we know, that D1 by P0 plus G, that we have seen in the few slides before. And now, as you say, in Gordon's approach, we are calculating the growth rate as the product of B into R. So, here the retention rate is 0.7 and the rate of earning is 0.15, means 15%. So, the growth rate will be 10.5% effectively. Growth rate will be calculated as taken as product of these two, and the effective growth rate will be 10.5%. So, if the dividend is say ₹1 which is given and the face value of the share is ₹10, then putting this value we get the cost of equity will be 21.55%. 21.5%, 55% will be the cost of equity here. We will now go to a combination of this thing, your preference shareholders, which is a different kind of share, as we have learned earlier. The preference shareholders are the paid dividends, are paid dividends at a specified rate. Here the dividend is not varying. So, it is decided before. So, this is decided on the face value when we are issuing it, and this is not charged as an expense. The dividend charged, as you know, that it is not charged as an expense. So, you do not get any tax benefit. So, that way it is not exactly like a debenture, but it is treated as an appropriation of the after tax profit. But dividend paid to the preference shareholders does not reduce the tax liability of the company, because it is not being charged as an expense. So, the cost of preference shareholders can be considered in two different ways. One is the not redeemable preference share capital. Preference share capitals can be redeemed or it cannot be redeemed, depending on what kind of contract we have with the company. So, when it is not being redeemed, then what is happening? Then the cost of a redeemable preference share is similar to the calculation of perpetuity, because then it is open ended. The other side is not fixed when the share can be redeemed. So, the cost is calculated by dividing the preference dividend by the current market price and net proceeds of the issue. It is more or less similar to previous calculations, like where we are, and the cost of this irredeemable preference share is given by Kp is PD by P0. So, PD is annual preference dividend. How much you are getting is fixed. It is fixed. So, you do not have to think about the growth rate here, and P naught is the net proceeds from the issue of the preference shares. Now, net profits, this is nothing but the issue price minus the expenses like the flotation cash cost as usual. So, if the issue price is not given, assume it to be equal to the current market price, whatever it is there, the company is issuing the same thing at the same price, if it is not giving any additional valued or discounted value. So, the current market price is the issue price, and of course, the expenses, if the flotation expenses are not given, then we assume this as a 0. It becomes pretty simpler, just like in calculating the PD divided by P naught is the cost of capital related to the preference shares which cannot be redeemed. So, it is perpetual, that means it goes on and on and on. Now, say your Messrs Shingbi Soapstone Limited issues 1000 preference shares and at 15% dividend and 100 rupees each, the share will be, the face value is 100 rupees each, but while issuing it is giving a 5% discount, 5% discount. So, what is the cost of this preference shares? It is Kp equal to Pd by P0. So, Pd is the face value is 100 into 15%. So, you get 15 rupees per share every year, and here P naught is given a 5% discount. So, the price becomes 95 rupees into 1000. So, we get actually 95,000 rupees from the market, because we are giving 5,000 rupees 5% discount. So, if you just now calculate the cost of capital is the 15 rupees per share dividend multiplied by 1000 shares that we have issued in the market, but actually we received 95,000 because we have given 5% discount. So, 15 by 95 is just by calculation, it comes 15.78%. 15.78% is the cost of capital. That means the cost of using the capital that we have got from the market by issuing preference shares, where we have committed to give 15% dividend every year, and while issuing we have given a 5% discount. Now, in this case, the cost of redeemable preference shares, these are to be redeemed on maturity. When the term is matured, then it has to be that means the company takes it back, and then it has to the original price at which it was sold has to be paid back to the investors. Now, the cost is similar to the redeemable debentures, absolutely same, except that the dividends paid to the preference shareholders are not tax deductible, that we are repeatedly telling. This is the major difference between the preference share and the dividend. Now, the cost of preference capital is calculated as same thing, the PD plus the redemption value minus the net profits divided by the number of years, that means the remaining life, whole divided by redemption value plus NP divided by 2. This is the average term. So, now PD is the annual preference dividend, RB as I said is the redemption value, NP is the net profit from the from issue of preference shares, and N is the remaining life of the preference shares. So, from here we can find out the cost of capital for the redeemable preference shares. For example, in this case what we are having that the PD is 10% of 100, because the Messrs Laxmi Mineral has issued 2000 shares, preference shares, which are 10% dividend as commitment, and the face value is 100, but at 95 is again it is issued, because there is some flotation cost involved. So, now in this case it seems that some discount has been given. So, the company proposes to redeem the preference shares at the end of the 10th year of the date of issue. So, now we have different values here. The redemption value is 100 for each preference shares here, but at the time we of issue we actually got 95 rupees here, because we have given some 5% discount. So now from here we get 10% of 100 is the PD value, P into D is 10, and the net profit is 95, because we have given again 5% discount in this example also. But the redemption value is 100, because the cost of the face value of this preference share was 100. Even if you have given at a discounted rate, when you redeem, then you have to pay 100 rupees. And N is the 10 years period. At the end of this, we are redeeming the preference shares back to the company. So if you calculate this, put all these values here, then you will get the cost of preference share capital is 10.77%. This is how it is calculated, and this is also you must remember and practice also these problems. Whatever I am giving in this, or we are giving this in the lectures, then you must practice this with different values and see how it changes. So we become proficient in understanding the problem and solving the exercises that you get here, and from there also you can think of complications, or you can also read other books and other resources where more complicated problems are given, but the basic ideas of this will help you great in solving the problems. Now it is the last one in this lecture, is the cost of retained earnings. See, like the other sources of funds, retained earnings also involve cost. So this is a little bit peculiar concept, because we are reinvesting certain part of earning back to the business. So it is the opportunity cost of the dividends foregone by the shareholders. The shareholders could have got this money, we have not given. What we have done, that part of the earning we have kept and used back for the investment. Otherwise we could have given to the shareholders. The shareholders could have used for other purposes. At the same time, we being the owners of the firm, so instead of giving or retaining in the same business, we could have given in somewhere else. For example, some real asset we could have used this. So in both the cases the opportunities were missed. So what we foregone, rather we foregone that, we had foregone the opportunity. So in both the cases this is important. The shareholders also, they could have invested somewhere else, but instead the part of that, the shareholders or the owners of the company, they decided that certain part will be reinvested in that. So here the firm had two options, for example, that it could have invested somewhere else, and otherwise we have an alternative that we pay dividend to the shareholders. But what we have done, that we have invested in some other, we have reinvested in the same firm, and thereby the shareholders also lost the opportunity to invest. If they had they got it through as dividend, they could have used this this dividend, extra dividend, in other financial assets. So here the cost of capital will be taken as the opportunity cost of dividends foregone by the shareholders. So if the cash is reinvested, as I was telling you, the opportunity cost is expected rate of return that the shareholders could have obtained by investing in financial assets. So if you are losing, say, 10 rupees or 100 rupees, then if you think that if I don't do this, if I invest this in other financial assets, then how much I could have received from that opportunity, that we are losing. And the cost of retained earning is often used as interchangeably with the cost of equity, because it represents the expected return of the shareholders from investing in the company shares. Because it is the same thing, because if you are not using this as shares, same money, then the expected return will be taken as the expected return per share. So it is as good as having the proportionate number of equities in the same company, which we are not actually doing. We are actually not giving them as extra shares, but we are reinvesting. So, net worth of the company increases definitely, but the shareholders are not getting direct benefit from there as dividend. Now, the cost of equity is higher than the retained earnings, since issuing shares incurs flotation cost and shares may be issued at a lower price than the market value. So, instead of going of issuing the shares in the market and getting more your capital for reinvestment in the for investment in the company, the this in here what is happening, the retained earnings are having that kind of benefit. We are not using any kind of flotation cost, we are not using any kind of discount here. So, in that case the cost of equity is definitely higher than the retained earnings. In case of equity, it could have been sold at a lower price, or you must have used some, definitely there will be flotation cost. So, in that case retained earning is a better option that way, from that point of view. Therefore, the formula used for the cost of retained earnings are the same as those for cost of equity, as simple as that. So, here what we have not discussed are, there are two more methods for the calculation of the cost of equity, as I said in the beginning, which will be taken up in the next two lectures. And for understanding these things better or in details, you could definitely visit www.icai.org or books like the Financial Management by P.C. Chandra, or there are many books available, many internet resources for understanding and then honing your skills for practical applications in much better way. Thank you very much.